Welcome back to MFC Live by My Financial Coach. My name is Enpo, the Chief Operating Officer. We work with probably about 400 plus very highly compensated physician families, and oftentimes we focus on a lot of topics that are near and dear to their hearts. In this case, we're going to be talking about student loans. This is in preparation to our article being published in the American Association of Physician Leadership, going into the decision-making framework of how to think through what to do about your student loans, whether you should pay them off or whether you should aim to get them forgiven. We're expecting to go over some of the recent policy as well as legislative changes around student loans. Really excited to introduce Chris, who has worked with many different physician families in making that decision. So without further ado, onto our program. Welcome back to My Financial Coach Live. Today I have Chris Pfanstiel with us. He is quite the accomplished individual, but mostly here at My Financial Coach, we involve him in conversations around student loans. I certainly don't want to steal from your thunder. So Chris, why don't you give us a little bit of background about yourself and your firm?
Sure, Empo, thank you. And thanks for having me today. So Chris Pfanstiel, I've been in the industry going on 15, 20 years now. My niche initially was working with physicians, which meant having to have a deep understanding for, most major issues you would imagine, most tax, student loans, creditor protection. But certainly when you think about student loans, young physicians with hundreds of thousands borrowed have a real sense of anxiety or stress around them. So our firm became very well read, well researched, and prepared for conversations on just those. And our firm, Axios Wealth Advisors, is a nationwide firm, but we work out of Pittsburgh. And like I mentioned, we work certainly with a great deal of physicians, but we're happy to help anyone, especially as they're thinking about their student loans.
Well, on that topic, Chris, there's been certainly a lot of fast moving information, everything from a new administration at the start of this year, just getting started with their legislative as well as policy agendas. Lots of different, individuals feeding into that uncertainty. If we were to really just cut through the noise here, what's staying the same and what do you feel is changing both legislatively as well as from a policy perspective?
I would say that change is the thing that's staying the same, right? We're now looking at if you go by term, not by person in office. I think we've all but one term since PSLF was created, going back, let's call it back to Bush. We've had nothing but change, right? Obama term one, we had pay as you earn. Term two, revised pay as you earn. We had not a whole lot of change in Trump term one, but you go to Biden, we had the SAVE program, and then now we have RAP. In terms of the big things that are going to shift, I was actually relieved to see something stayed the same. I'm going to share first, which was in the SAVE program, there was an interest subsidy on any amount of unpaid interest. So your loan never spiraled out of control, which was the big fear that someone might have during residency, during fellowship, or even early career was that their income-driven repayments just didn't even cover interest. And those loans would get larger, larger, larger into almost laughable numbers. Interest subsidy is going to still be there in the RIP program, which I like that a lot. That's staying. I'm going to say staying from SAVE. Remember, there's a half an interest subsidy in revised pay as you earn. In terms of what's changing between 26 and 28, we're going to see a different formula for how they're calculating loan payments, RAP. It is said to be simpler, and when you look at it, it is simpler than navigating all of the different programs. However, some of the things that I wish might still be there from the old programs, things that helped our clients a lot, will start to go away. For example, if you're a high paid specialty, especially one with a smaller loan balance, you used to want to join IBR or pay as you earn. early and get a payment cap. The payment cap is scheduled to be going away. Um, the cuteness of filing taxes on extension and maybe separately is going to start to fade away as an option to reduce payments. We're concerned about that, in fact, on some borrowers too, and such. But really, the big things are going to be slightly more expensive calculation for payments, and then foregoing some of the cute tricks we used to really benefit from to keep payments low on the way to forgiveness. And for folks in private practice or just folks not doing PSLF, it's now going to take 30 years of more expensive payments to get long-term forgiveness. The relief here is that PSLF is unchanged.
So I think that one of the things that we've talked about with our clients is this idea of, hey, how much flexibility do you want versus what sort of government relief are you going to get? And one of the things that I think has recently skewed the equation quite substantially is the idea that interest rates, over the course of last year substantially increased. And so what we're starting to see is a lot of our clients who just recently graduated, they don't really have the option to refinance into those 2-3% loans like they did back then. Will that substantially change in the near future if there is a lowering of interest rates, or do you feel that it still makes sense to kind of keep your eye on the different government programs and incentives that roll out?
Yeah, so we'll talk about a couple angles on that. If they just graduated, I think it's really worthwhile to have a conversation about interest subsidy because payments could be very low based off certain incomes. We'll see, how interest subsidy evolves over the next few years. But what we see now is that any unpaid interest. So if it's a large loan balance, there's a large amount of unpaid interest. Any unpaid interest is subsidized. That is not a change in the interest rate itself. The base rate is the same. It's just a subsidy on that which is unpaid. So for the first couple years, and this might align well with the perceived inversion in the yield curve, for the first couple years for someone who just graduated, maybe interest subsidy makes it so that a arguably effective interest rate is actually lower than the banks would have given us back in the day anyway. That having been said, if we see the yield curve come downwards and interest rates do dip, then sure, there could be a lot of value in a future refinance. I think keeping your uh, pulse on the rates and watching them and understanding what it would cost to refinance is sensible. However, I do want to go back to if the rate that we're paying adjusted for subsidy, if there is one, certainly when you've filed a couple of tax returns and attending, subsidy's gone. But if the rate you're paying isn't dramatically higher than the rate that the bank is going to give you as a refinance, then I stay in the federal program and see what other types of perks, forgivenesses, values, death or disability discharge, see what else is out there that might round out your thinking because no one's as forgiving of a lender as the federal government right now in the student loan space. The only other thing I'll mention is when you talk about refinance, if that same borrower borrowed from, and I'm not going to pick on any companies, but there's a few that have notoriously high interest rates when lending while you're in school. If you've borrowed from some of those lenders that have very high interest rates, refinancing your private loans is far more often a no-brainer. Federal, I like to lean on some of those perks and benefits available to say there needs to be a real meaningful savings for me to pull the trigger.
Sure. And I think for a lot of our clients that are listeners to My Financial Coach, oftentimes we do know that they have, reasonably high incomes, but they also have what I call a lot of delayed happiness. This is going to be individuals who, might be getting closer to their 30s or just recently crossed that threshold. They're making good money now, but they may not own their home. They may have put off having children, getting married. With those things in mind, do you feel that there's still an incentive one way or the other to look into private versus keeping them public, knowing just that sometimes it's a cash flow issue? You want to be able to afford the things that you want to afford.
You know, the way these formulas work, I haven't found too many scenarios. Now it's about to go up in price, but the way these formulas work, I haven't found too many scenarios where I couldn't make the justifiable financial decisions come together, while also pursuing some of the federal, loan repayment programs. That having been said, if someone is in arguably private practice, maybe they signed a contract where cash flow is not that great. Maybe there's money being held back from bonusing or other productivity to go towards a buy-in or something like that. We can have conversations all day about forbearance or other strategies, but sometimes someone just should go to a student loan lender and take a 20 or 25-year repayment, and then when cash flow opens up, maybe reaccelerate those payments. I certainly respect that that exists out there, but I try to exhaust any scenarios that keep us federal to see if that works in the financial plan before I go to those. But that doesn't mean they're not answers for scenarios. They certainly are.
Sure. And I think we keep kind of going back and forth between the, hey, you've really got to think about these federal student loans before you think about refinancing, because, and this is something that maybe some of our listeners know or don't know, but you don't get a second bite of that apple. Once you refinance, my understanding is you can't really go back to those federal loans.
Yeah, and but you're exactly right. There's no going back. So if you make that move from federal loan to a privately refinance, that is an irrevocable decision. And I'll give a quick example. I had a surgeon who was really excited to work in a private practice, and he was okay with the student loans being what they were. I don't think he was there for more than 8 months. Maybe it was 3 or 5. In fact, I think we talked on the phone in November. So he probably finished training June 30. He was probably 3 months into working if there's a month or two off, right? Um, and his private practice was absorbed back into a hospital system, which brought him back into PSLF eligibility, and that's great for loans. But sometimes things change, and I bet if too much more time had passed, right? This was during COVID, so the CARES Act had made his interest rates 0, so we didn't refinance at the time. But if you think about it, if that happened in 2018, we probably would have seriously considered refinancing to private. We would have had student loan interest all the way through the CARES Act for years when it could have been 0, and he'd be PSL ineligible, even though the practice he went to was put back into a hospital system as a nonprofit. So we could regret a irrevocable move, even if it sounds perfectly suitable at the time. So like I said, I err on the side of federal and caution, but again, that doesn't mean it's the right answer for everyone.
So speaking of that, I mean, everyone makes different levels of income, and they should honestly make decisions based off of that, whether it's personal consumption, financial goals, etc. Being that most of our clients that we work with tend to make higher incomes, and for the most part, were not making great incomes before they came into the larger incomes. What would you say is the most important thing for high income earners to consider when looking at their student loan decisions?
Well, it, between 26 and 28, and even for a little while longer now, if we can catch them before that high income has been recorded on a tax return, understanding the payment caps that were there in pay as you earn and IBR, understanding those en route to PSLF is probably one of the most important, right? RAP looks like it's going to be the end of payment caps, but go back to what I said near the very beginning, where when have we not had a presidential term without major student loan change, right? So even if we talk about RAP now as if it's in finality, I want to be really cautious that we could next term have a completely different set of rules. Okay. So knowing that, I think understanding payment caps for a high income earner is the first most important thing. And then if those are gone, then understanding what the payments would cost en route to ultimately forgiveness if they're a nonprofit. And if they're private practice, then that's just not, obviously an option. So 30 years forgiveness for long-term forgiveness for a private practice doctors in RAP isn't on the table, right? That's too expensive. So they would at that point talk about credit and banks. And at that point, if they're going to buy into a practice, they should just understand that if they do a significant refinance, we want to understand the impact on their debt to income ratio before they try to go apply for a big loan to buy into a practice.
Sure. And so I'm sure everyone loves little short one-liners. You got the TikTokification of the world, and there are a lot of people nowadays saying that the government is coming after them for their unpaid student loans, and there may be a number of individuals that just kind of put it out of sight, out of mind. There were all these COVID measures. But allegedly, there are people now that are worried that the government is coming to garnish their wages or deplete their bank accounts. How much of this is fact? How much of this is clickbaits?
So there's a very big difference between I'm in forbearance and I've been ignoring my bills. Okay. The government, if you've been ignoring your bills, you could call and ask for forbearance. You could go into an income-driven plan where payments could be as low as zero. In RAP, the lowest payment's going to be $10. For the people that are in a position where they're saying, well, maybe the government's coming after them, for those folks, it may very well be a lack of good advice. It may be a lack of usable and digestible and easily understood information. However, those people have had a lot of ways to not go through this. And it comes down to simply they need to understand and pay their bill or go into forbearance. And this would never happen, right? It's not people that asked for and were granted forbearance that have this problem. It's not for people who have played by the rules and stuck to it. It really is folks that neglected communication and neglected to pay if they were billed. Those are the folks that are being come after. And most lenders, if you don't communicate with them and you don't pay them, most lenders end up seeking a garnishment or a collection of some sort. And then that's what we're seeing here. But again, there's so many ways to keep your payments low, and there's so many ways to get forbearances and such if it's unaffordable that I think most people just need to know a little more about their options, and then their fears can be, subsided.
So I think that that's a good point. Certainly, no one wants to say that they're a blameless victim in all this, but there are. I would say that people kind of grow their lifestyles around their incomes, and if you've been living, not necessarily beyond your means, but a little bit, you've committed more than you really should have in the past 2 or 3 years when all these programs that were a hangover from COVID happened. You've now made commitments. You've now created lifestyle contingencies. It's really hard to put that genie back in the bottle. So when people say, like, I just can't afford it, this is ridiculous. The government's now taking away my money. How am I supposed to live? Are there still options for them? Or by the time the government starts garnishing your wages or, taking money from your bank account, you've run out of options.
Well, if you're looking at the releases from a few months ago where they said, hey, if you have unpaid balances, we're coming. That's the wage garnishment conversations. If we're talking about folks that are in a forbearance and they're just used to a $0 payment, but they've followed all the rules perfectly, they're just used to a different situation. And now those folks are going to start getting billed based on their income. Maybe physicians, as we're talking to the audience today, 1,000, 2,000, 4,000, 6,000, whatever it is a month based on their wage, right? For those people, this is going to be very possibly a very real adjustment. You can get forbearances to the point we made earlier. Well, it's irrevocable and PSLF would go away. You could do a refinance to a 20, 25-year payment plan and try to keep it low. But unfortunately, if we borrowed these amounts of money in a record high tuition environment, to the worst of it, if we borrowed it, we're going to end up having to swallow a tough pill and start making payments and real ones. We've benefited from a nice break. If that break gave us a false sense of security, then unfortunately it's going to be tough news for the budget. Like I said, you can on-ramp slowly through maybe getting a forbearance. You can depart the program in a long-term refinance, but payments are going to be due. That is a very real part of it. And they're not going to come after your wages unless payments are due and you neglect them for some time. But yeah, unfortunately, the on-ramp's going to be tough for some families.
All right. Well, we hate ending on a sour note. Certainly, it sounds like there is some truth. I mean, some families are going to face some very tough dinner table conversations. And it does sound like there is a lot of moving pieces to this very large puzzle. But if I had to end this, I do want to end it on an upbeat note. There's a lot of different things that are certainly headwinds, but if you could, maybe go into some of the things that might be some good news for borrowers, what would you say that is?
Yeah, I mean, I would say the most important thing is that PSLF is still here, right? I think for the last, I'm going to say more than 10 years, I've had clients asking, is it going away? Is it going away? Is it real? And that's always been a fear of folks. I think the fact that PSLF is still here is very important. I think the fact that the save forbearance and the PSLF buyback as a way of capturing that time is still here. That's a huge, huge win. And I think the fact that RAP is planned to have an interest subsidy so your loans never spiral out of control is also a huge win. So if someone trains for 8, 10 years on their way to interventional cardiology position or something like that, then my goodness, their loans could have tripled or doubled, over maybe doubled's more fair to say, 7% over a 10-year type experience. That's just not going to happen. So a lot of very good safeguards are still there. And the fact is that the government's still a very generous lender. You can get forbearances, you can pay based on your means. These are things that a bank just doesn't do. So a lot of good news around PSLF still there. And I think it comes with the responsibility, NPO, of folks knowing to talk to you, talk to April, talk to the other coaches, seek out some expertise to say, hey, how do I navigate this if the best path forward isn't abundantly clear? But I think a lot of good things stayed. I'm personally going to miss payment caps is something that's going away that I used to like to use for families.
Well, we always appreciate your insight, Chris, and we look forward to having you back on My Financial Coach Live in the future to give us an update as we get more clarity and as bigger changes, I'm sure, are set to roll down the line.
I'm sure they will, and I'm happy to join anytime.
Well, audience and guests, I think that we learned quite a bit today on our program. Lots of things to consider. I think the area that I was surprised at is that despite there being a lot of noise, a lot of fear and anxiety about all the changes to student loans, student loan repayments, the fact that change has always been a very big part of student loans makes me feel a little better knowing that we certainly are going to see not just changes in the future, but we've already gone through and experienced changes in the past. And we're still alive, we're still here to talk about it, but I think that it does make sense for us to be more strategic than ever, considering there are more programs than ever. There were programs that you were on that are no longer around. It might be time to revisit. What exactly am I doing about my student loans? It might not even be your fault that you're either falling behind or you don't know what's going on because it changes so much. So I think what I would recommend everyone does is look at your own strategy. See if it's still good to go, or if you need to make fundamental changes. And when you do need to make these fundamental changes, think through your personal situation. It's not good enough to read articles that give you general advice when you don't know what path to choose regardless. Hopefully this episode helps you think through it a little bit more. As I mentioned earlier, we are releasing through the American Association of Physician Leadership an article on how best to pay down your student loans and what that decision-making framework should look like. So what I'd like to ask everyone to do is really go back and review those student loan programs that you're in. Review your payments. Really think through, hey, do I really want to deal with ignoring this and potentially one day having my wages garnished or the government knocking on my bank's door? And I think if we can do that, and of course, work with professionals to choose the best current course of action, not in general, but for you, it would be a complete win all the way around. Now, if you're interested in these financial topics and more, please follow us on Spotify or subscribe on our YouTube. And remember to keep an ear out. More episodes are on the way soon.
Is this going to be the 2020 vice president debate when there's a fly on Pence's head for half an hour?